Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, hi guys, welcome back to the channel. I know that I've been having a lot of questions around what is the best strategy, what's the #1 trading strategy that I would recommend if you're new or you're studying to learn how to trade. Now there's a reason for this. I mean, we're talking here, for me, it's more than 15 years in this business and I've seen everything. I kid you not, I have seen everything. I wouldn't say I've done everything, because I'm just not that kind of personality. I've looked at various different strategies, had to back test them for various different reasons, had to forward test them, look at their results. And the one thing I can say is that markets behave in a specific way and they'll always continue to do that. It's because it's the nature of what a market should be in order to make itself, right? So, you know, we talk about market making, right? That's all it is. When making a market, in order to make a market, you need to follow certain principles. The first principle is you need an advertising mechanism. In most markets, or in any kind of auction environment, that will be the price. Most people react to price. It is how we're conditioned. I mean, we have been brought up for generations in a world where money exists. And for as long as we're in a world where money exists, then we're going to look at money as the motivation to do things, right? So that's the trigger points. That's what really gets to our emotions. And by this, I mean that we are seeing price advertising to us. That's all that's going on. So in the context of the Forex market, because I know you guys love Forex, and I'm going to keep saying this, I know you guys love Forex, but I promise I'm going to start doing a series of videos that are not primarily focused on Forex. It's because I know a lot of the people who come to watch my channel and watch these videos and want to learn how to trade have been brought into this business via Forex. Whilst I might have my differing opinions in terms of whether this was the best route into trading, whether this was going to make you sustain this business, it was going to make you happier, it was definitely going to give you the sort of fuel that you need so you could spend pretty much the amount of years I've spent in this business. Well, it is what it is, right? It's just my opinion. But that said, when it comes to trading in general, there is a set way that we go about things, right? And I'm going to show you how that works in this video. Now, of course, I've done tons of videos like this, but I'm going to show you how this works. So if we use Forex as the overarching focus point here, so I've got a chart up of cable on the screen. Now, the price that we see is basically saying to us, buy me, sell me, right? And that's how most people react to it. So for example, we're trading 127.58. The price is saying, ooh, I'm going up, buy me. Now, I know a lot of people will be putting in long positions right now if they're not watching this video, because price is giving that vibe, right? Now, I'm using a TPO chart, so I'm filtering out a lot of the information you would have seen, say for example, on a candlestick chart. So if you're looking at this, you can see a lot of colors, so it's gamified, and you can see a lot of movement, right? So the bar itself changes shape consistently, which causes you to over-engage with the chart, right? So you're over-engaging. So it's actually, there's some gamification to also the fact that price is advertising to you, I'm going up, I'm going up, I'm going up, by altering the shape of the bar, but also it's a gamified element, right? It looks like a video game. You know, when you open these charts, whether it's TradingView, you can change the colors, you can customize it, make it less video gamey. In the old days, when I used to be very, very active in the markets from an institutional level, what I would tend to do is I'll change all my charts to black and white. So I'll go traditional. So I'll change the green bar to white, and I'll change the red bars to black. So it takes away the gamification element. So when they're moving, it looks very static. It looks so boring that there is just no emotion in it. It's like completely dead. So I refrained from making my charts pretty and look good. But because I'm doing a YouTube video, I kind of leave my charts this way, because if I don't do that, most of you are going to tune off after about 2 minutes, right? It's going to be like zero engagement. No one's going to learn anything. To avoid that, I mean, it's already bad as it is, right? You know, I've got thousands of subscribers on this YouTube channel, and reality is reality. Most people who stay with this channel want to learn the truth and probably go on to succeed. Most people don't want to stay with this channel because I tell the truth. It's boring. I'm not a talking head. I'm not doing the typical engagement tactics that is used across YouTube. What I'm focused on is showing you exactly how the game works. And for some people that's boring. I mean, God, who wants to succeed in trading, right? When you have the opportunity to moan and complain that you're not succeeding in trading, and you can be part of a community where everyone consistently fails in trading. I mean, it's fantastic, right? I mean, why would you ever want to quit an environment like that and become successful and lose your audience and be that guy that everyone says, another guru who's telling me to do this and telling me to do that. How do I even know he can trade? I want to see your P&L, right? And then it boils down to just brute force. I want to see your P&L. Show me what you, and then you show the P&L, like, oh, you probably faked it. You're gonna have a lot of negative energy when you start to do well in this business. When you actually have value to contribute to the community, it's not going to go well for you, because sad to say, this community is largely built on people either putting other people down or generally the sell side just selling you stuff, right? So going back to that principle of price is just an advertising mechanism. That's it. Simple as that.
Easy peasy lemon squeezy.
It has no other value, right? And the easiest thing to relate this to is like the crypto market. We all saw meme coins go to, Terra Luna. I think it went from like $3 to over $100. I mean, I was in that investment. I did pretty well because thankfully I got out about $50. People did hang on, for longer, right? So that was a crazy time. If you couldn't make money in crypto, you couldn't make money in anything else when that bull market was going on. And that's just going to show you that even worthless things like what Terra Luna was doing could attract an audience, and people will purchase it and the price will go up. That price actually absolutely meant nothing when the company got liquidated.
What's up, big
Right, so as a trader, I want you to think about price as purely an advertising mechanism and nothing else. Okay, so we're going to track back now and let's talk more in depth. So let me actually show you now something. Let me put some flesh on the bones for you. Okay, so just to reiterate the point before we move forward, as you can see, it was exactly what I was saying to you guys, is that as you can see, price advertised to a lot of people, and a lot of people would have decided they're gonna go, they're gonna buy, and now look where we are. So if that's not proof right there, then I don't know what is. Anyway, if you're watching this video and you're one of those people, well, this has already started to hammer the point home. There are many reasons why we wouldn't want to be long here, and I'm going to explain that. So in order to do that, I'm just going to pop over to my TPO chart, which is what I prefer to use 90% of the time. because again, you can see the difference as well, right? So look at that, right? Now, look at that. What a difference, right? So it looks so clean and clear and just not visually intrusive. Anyway, what trade should you have been doing? Now, we spoke about that before. So we had the R period low going back 1, 2, 3 days, right? So we had the R period low going back 3 days. So we can see that that was the Chicago Open. And what do I always say to you guys? You want to trade sessions where there is strong liquidity. You don't want to be trading sessions where there's no liquidity. I used to love the European session because it was early liquidity, but it really suits people who like to trade out of opening ranges. And I've spoken about this in some prior videos long before these, but I won't talk about opening ranges today. Today we're primarily focused on the idea of liquidity, right? So to go back and rehash the point, we primarily want to focus on where there's liquidity. And where do we say there's normally liquidity? Now, that's the good thing about the profile. If we go back, we can clearly see that we have value low. So let's just highlight this again. Value low from a couple of days ago sitting here. This is a statistical support benchmark, and this is some of the stuff we can see on a profile. Every professional will tell you this. There's things you can see on a profile that you can't see in anything else.
Don't argue with my superior wisdom, okay?
So I know that this is an area of support. What else can I see? I can see that this is a discount because it is down the sort of 80 to 100% mark of the entire range, right? And I can see that we've got these liquidity lows where stops tend to cluster. And I know what happens if you've ever seen a depth of market, you'll be able to clearly see what happens when we hit into stops. You would hear professional traders say we're hitting the bids, right? That's the term that gets used. It's not really liquidity hunting or stop hunting or some of the other catchy phrases, of course, they've developed that all of us have to now start using. Otherwise, that's a problem for the YouTube algorithm, but that's not what we would normally describe it. Yes, it's liquidity. We understand the concept of liquidity. However, it's just bids, right? Just orders stacked in the book, passive orders. People have to put them in order to manage their risk, and that's why they're always there. So if you look at any central order book, so if you trade futures on the CME, you'd see in the central order book, you would see orders, passive orders sitting there. Some of them are even fake. You'd see people quote stuff in, layering. You see all kinds of tactics going on. And that's because they got to do them. They're orders, right? That the whole business is about exchange. So buyers are trying to sell, buyers are trying to buy from sellers, sellers are trying to sell to buyers. It is just how the business works. So I already know that there's going to be a lot of liquidity down here. I know this is a statistical discount. So from here, once I see the trigger, right, I'm looking for a liquid session. So you can see this happens somewhat about 11 a.m. London time, so it's normally never adequate. I always say to traders that wait for US session to start. So we had that very early liquidity brush, and then we closed above, we broke structure above M period, and then we started to push up in O period. Now what's O period? That's 12 new, that's pre-market. There was a lot of big moves pre-market. Usually this happens when people are contemplating really big information coming into a NASDAQ open. Right, so this is normally a play that you would see developing in the stock market. It's not normally a native FX play. It's probably the dollar being actively exchanged in the equity markets, and that is bringing correlated flows into cable. Right, so you can see that in O period we had a strong move, but then just watch how we back up again. So usually you would want to be making your trade somewhere between Q and R period to get long, right? Not because we saw the flush here means we're going to go short. In fact, you would never want to be short in a hole, right? It's what I call it. You never want to be short in the hole. Discount prices are the hole, and that's where you are going wrong.
The answer is never. Do you hear me? Never ever.
So if you're a Forex trader, one of the things that no one is ever going to tell you is that that's largely where you're going wrong. You're trying to get short in the hole. You shouldn't do that, right? You can do whatever you like, of course, but you shouldn't do it. So I would look to get long here. And where am I looking to get out? Usually at a liquidity high. So we've seen 127.50. That's where we know that they're going to be stop clusters. And what else can we see? We can see that there are offer stacks right here. So that's another high liquidity area. We've got value high and an offer stack. We've seen this offer stack become a problem before in terms of breaking it. And what's happening right now, we're trading back into it and we're struggling, right? And what session is this? This is a European session. It's a London session. This is you don't want to be involved here. In fact, 8 a.m. was the London Open. We had a K period. I mean, now we're pretty much sitting at 10 a.m. You don't want to be executing trades at 10 a.m. Look, guys, I kid you not. So even though we've traded up and we've hit a liquidity high and now we're trading lower, if you get short here, what could happen? We have a lot of unopposed buying here. We have a lot of unopposed buying here. We could find a degree of support in here, some more liquidity that could push us even higher. So we don't want to do that. We want to wait for the US session to open because there is a good chance that we could get flushed lower. And if that happens, it might present a buying opportunity. But what do I always say to traders? You don't want to buy at fair value, right? So where the price is trading mid-range, you only want to buy at a discount. So the next place we should look to buy should be liquidity low. Our period, best case scenario, we have a pullback here and we trade into liquidity low, or we break the M period low, or we have a pullback, we settle, and then we trade the liquidity low of whatever low that we create down here, right? You can't see that now, but that's what we should be looking for. Now, if the market trades here and then starts to come into a US Open and starts to trade heavily short, we could short for a liquidity low, right? But there are a lot of other nuances that we have to consider. For example, let's pop on here for a little bit. We want to consider the volume, right? Now we can clearly see that the volume driving this came from this area here, right? So we can see the initial volume flush, and then we trade a little bit lower, kind of like a shakeout, and then we trade the liquidity low, and then we rebound to the upside. We can see that. Now if we take a look again, we can see it at Chicago at 3 p.m. That's the Chicago Open. That's where all the volume was. What does that tell you? That means the futures traders are the guys driving this, right? So they drove this up to the liquidity high. We've hunted liquidity. At some point at 8 a.m. in London Open, we actually did try and trade lower. Now, this is what I would say to guys, that I always wait for the strongest liquid session. You could get short on the London, but what if we just settle here? What if we pop back up and trade these liquidity highs? So we're just short of that. We could take the stops up here at 27.86. So for me, it doesn't make any sense trying to rush the trade.
Hurry up, we're gonna be late for school. Bruh, chill. I don't know why you're in a big time rush.
You can see that the volume underpinning this, if we look at it historically, right? So this is coming out of Chicago. I mean, you know, look at the kind of volumes that we see in a US session, right? So it's pretty high, right? So this pushed it. But again, it means that this is where the demand's going to be, right? So if we do flush, then we're looking for a reaction into demand. Right, let's take an example. We had an example like this, which happened on this day. I still have it marked out, and when we spoke about this. So you can see the demand was 8 a.m. London Open. That's where the demand was. We were unable to post higher volume until we came into the US session, right? And we can see that as we started drifting to that's New York Open, and then we had that big flush. And where did we trade into? That was demand. So this day actually looks very similar to this day here, right? So it looks very similar to this day here. We had a big flush in the Chicago session prior day. We're now opening the London, we're a bit tight. So there's a good chance we might trade right back into demand, right? And you know, if that happened, there could be a buying opportunity here, but we always want to see the liquidity. Now, I personally wouldn't rush in to buy it here. Absolutely not. Like I said, I would always look for a liquidity hunt to buy, and that is the single best strategy that you could use, right? It is the number one strategy. That's the first thing you have to have in the back of your mind. Did we just clear out stops? If we did, there's a high chance that your trade's going to be successful. See, we cleared out stops here. We know that already, right? We did it in the London Open. If this continues into the US Open, there is a high chance that we start to break structure at 27.42 or trade back in a major session. We start to chuck. We could probably going to end up all the way down. Reason being is that we've already seen a 5-way structure to the upside. So again, for guys who know about what I talk about in macro, we're already seeing that. There is absolutely no reason for you to be long here, like zero. Even if we traded down here a little bit and we popped, you're better off waiting for the sell. And it's just good principle, guys. Price is an advertising mechanism. Because it's going up doesn't mean you need to be a buyer. In fact, if it's going up, from a professional standpoint, in the market profile scene, we say price goes up to shut off buying. Price goes down to shut off selling. So it's not going down, it's going down to shut off selling. It's not going down just to draw in more sellers. Yeah, if you're a novice and you don't know what you're doing, you're going to be selling on the way down, right? That's the whole idea. Prices, you're taking the advertisement and you're going to get burned. So trading is the same as life, right? If it's too good to be true, it probably is, right? So if you see the market going up aggressively, just assume that this is too good to be true. I mean, I'm not going to be a millionaire today.
I'm a millionaire, bro. I'm an entrepreneur. Like, I don't have to prove no one anything.
Just say that to yourself. This is not going to be this day. So what should I be trying to do? Is I should be trying to look where the market has succeeded at shutting off all buying if it's going up. And now there's no one left to buy, which means everyone by default becomes a seller, right? This is the game. That's what we need to learn to do. And it's psychologically, you need to ingrain that in yourself. And if you can't do that, I can assure you, you're not going anywhere. You're literally chasing and biting your tail, you know, like those poppies that run around in a circle trying to bite their tails. That is what you are going to be. So sadly, as harsh as it sounds, that's just the reality of it. So again, I needed to show you guys I know you guys love these kind of charts still, but you know, this should hopefully bring it home so you know what you're looking at and you know what you don't need to be doing. Again, we pop onto our TPO chart. It's smooth, it's clean, it doesn't give us that anxiety. We can see that information on a candlestick and more, and that's why my focus is time price opportunity charts and has been for a number of years. So if you are looking for the single best strategy you can employ, this is it, guys. This is it. There are a lot of things you can do in markets to arbitrage yourself in income. But if you like Forex and you like to trade these things and you want to trade maybe on a intraday to swing basis, I like the 1 hour chart. Right? You see I use a 1 hour chart. I like that chart because it can easily become a overnight hold trade, or it could be an intraday trade, and I like to trade out a liquid session. So if I'm going to, like I've always said, it is completely worthless to you if you're going to be an intraday trade. I don't think anyone should be an intraday trade. It's like a complete waste of time. If I were to push this same idea, right, so we know that long term the market is bullish, right? This is a liquidity high on a weekly. Now take for example, right, so this was a liquidity low right here. So if we just get let's put a line here, right? So that was a liquidity low, right? So we know liquidity will be down here. We traded under, we hit that, and then we closed above, we traced on bids. This becomes a good entry point, right? So if you want to get, let me find another tool it's going to use. So this would be a great entry point, right? Or you know what? Who cares? You could have even entered higher if you wanted, right? But as soon as you're back in, that should be your average entry point, and this is the risk you're looking to accommodate, right? And you're going for liquidity high, right? So you want to trade straight into that so you get a fill. That's still a 2.5 RR if you're looking at it that way, right? I'm not going to say you would have been tighter. I mean, that's just unrealistic because you don't know where the market's going to go. But let's say you took the whole swing level, it's still 2.5x, right? And you're trading a weekly. So you had time to hold this trade, build into it if you like, or maintaining your risk and allows you to average in. and you'd get a pretty healthy return without burning commissions in the intraday. So it's the same thing. So you already knew directionally that you wanted to be long, right? So that's important. Again, we see a similar case from the, if you had that bullish bias a lot earlier on, you can see that we traded down, traded up, traded liquidity, and then hit back down again and then closed up. That also became a great entry point, right? And look how far this market went. So again, when we traded back in, you could have covered. So as soon as we're over liquidity, could have covered up at 25.09. We bounced, reclaimed the zone. You could have gone for continuation, for example. So there are lots of ways that you could have attacked this. Awesome stuff, guys. I hope this makes sense. To my next video. Adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?